Following the Berkshire Hathaway annual meeting, I received a very interesting email from an MOI member, a fund manager and longtime member, and I'll read the email to you and then I'll provide my take on it. And I'll just flag up front that these topics I want to discuss in our next member call on June 24th. This will be accessible. It will be a live Zoom call accessible to MOI Global members as well as Latticework subscribers that are on any paid plan. So let me read the email to you. It says, I'm wondering out loud and don't know if you'd like to opine or if this would be a discussion for the community. First, Berkshire is sitting on $380 billion in cash. Berkshire is a net seller of stocks. Is Apple that overvalued, or is Buffett seeing storm clouds on the horizon? Second, I posed this question on a panel, and someone else on the panel said, who has access to Buffett, said that Buffett has expressed concern over a large drop in the market. Third, Buffett reiterated cathedral and casino analogy and said more people are headed to the casino right now. Fourth, Buffett said zero-day options do not serve an investment purpose or a speculation purpose. They are straight up gambling. Fifth, and this is now the member posing questions, is this similar to 1969, in which Buffett couldn't find good opportunities and shut the fund down and sat there for 4+ years, and then the market cratered 50% over 21 months? Sixth, it feels similar to the dot-com push of 1999, when NASDAQ stocks jumped 85% for the year and 50% in the second half. Once the NASDAQ and the S&P peaked in March 2000, the NASDAQ fell 78% and the S&P dropped 56%. 7, there's lots of liquidity sloshing in the market today. 8, many large IPOs are projected to happen and may decrease liquidity. And then the member says, I don't like to make macro calls, but these things are getting my attention. I welcome any thoughts you may care to offer. So as I said, I can provide my thoughts, but what I really want to do is get the community involved and get informed people to share their opinions and then have a discussion on a call on June 24th. So in terms of my thoughts, and I took some notes as well, but let me see if I can sum it up. So I've believed that the market has been quite richly valued for some time. You know, after the post-COVID advance, and then we had a drop, and then we had another surge. And certainly for the past 6 to 12 months, valuations have felt quite elevated. What has kept me from shorting or even just holding a ton of cash is simply that, to me, we are in a period when the dollar debasement is very real. And so the stock market is quoted in nominal terms. So when you're shorting the stock market in an era where the dollar is being debased, where CPI is likely understating inflation, certainly in a lot of real categories that consumers are exposed to, then you are fighting a battle where time is not really on your side. Because the stock market in nominal terms could be a lot higher 5 or 10 years from now, simply because the dollar itself is being debased. And so that's a really tricky call. I do believe we're going to have a lot of volatility going forward. So there could absolutely be a crash. There could be a 50% drawdown in the market. I would not rule that out at all, but at the same time, if one just holds cash at a low interest rate, then one really would have to be in very short duration instruments, in my view, because you do not want to go out on the curve given what's happening with inflation and currency debase. So you are holding basically cash that's yielding less than true inflation. Just think of the cost of living for yourself. It's not going up 2-3% a year. I feel like in my case, I'm looking at high single-digit kind of increases. And that's just a very, very rough estimate. Certainly across categories in technology, you can say we're getting deflation, and I would agree with that. But we can't live on technology and digital goods alone. So what we need to spend our money on is going up in price, and that's being felt by the consumers on the lower end especially. So if you look at market valuation indicators, they are elevated to say the least. We have unprecedented concentration in the top of the S&P 500. The Buffett indicator is, I believe, at last check, slightly above 200%, which is very high. The CAPE, Shiller CAPE, according to the data I've pulled, it's actually among the highest in more than 100 years. And other indicators are also very high. So from that standpoint, I'd probably be holding a lot of cash right now, were it not for the currency debasement. So what am I actually doing? I am finding value in areas that are inflation protected, but are actually bargains right now. So a lot of investors have fled anything having to do with real estate or home building. We know historically that real estate over long periods of time is an inflation hedge. What happens in the short term as interest rates rise, there is a depression in the multiple investors are willing to pay, and that's fine, but that gets reversed and then some as inflation starts rolling into rents and real estate prices. And so when you can buy real estate companies at half or less of NAV, and maybe they even have an operating business attached to that. So in the UK, for example, you have home builders at a third or a quarter of NAV basically, and they have a very good home building business. They're market leaders and so forth, that over time you have a housing shortage in the UK. And this is just one example. You can look at other countries as well. And recently we published a write-up on Barrett in the UK on the Latticeworks Substack. I encourage you to take a look at that. So that's one example. Lowly valued cyclicals are another example. Anything connected to home building in the US, I think, is quite lowly valued at the moment. Bob Rabati talked about Builders First Source at our Omaha breakfast recently. I'd certainly agree that that company deserves a look and is very predictable when it comes to the cycles the valuation there goes through. Chemicals sector is another one that I think one can look at and find bargains. And so from my standpoint, that's really where I would deploy the bulk of capital at the moment. We did publish an article recently on AI beneficiaries in small and micro caps that aren't valued as such. So they're still available for a bargain price. It's the so-called Leopold Aschenbrenner thesis. Situational awareness is the title of that particular post on Latticework. And the idea there is that these companies are not just theoretical AI beneficiaries, but actually we pulled their latest earnings call transcripts, and there's already evidence that growth is accelerating, that profitability is accelerating, and yet these companies meet at least one of our value criteria, either cheap on price to book, cheap on sales or earnings. So I'd encourage you to take a look at that as well if you want to have some exposure to the AI trend but don't want to pay up for it. And by the way, only about a year ago, you could find bargains in storage companies, hard disk drives, and so forth, companies like Western Digital, SanDisk, Seagate. And those stocks are up more than tenfold in some cases. SanDisk, I think, is up almost 50-fold in a year.